My beautiful friends, that's the number on every poster, every podcast, every HR pamphlet since the dawn of time. The age you can finally crack open your 401k without the IRS penalty breathing down your neck. I sat across from young people in my office for 40 years. Sharp, ambitious, forward-thinking people, and 9 times out of 10, that was the only retirement number they could name. 59 and a half. As if the entire game ended right there. Then 62. Social Security comes knocking. The government sends you letters. The Retirees Association sends you letters. Your spam folder practically throws you a party. Fine. Everyone agrees 62 matters. Then 65. Medicare. The finish line. The golden handcuffs finally come off, and people act like they've crossed into the promised land. But 61? My dear ones, my friends, complete silence. The entire financial world goes quiet. No letters, no podcasts, not even a little congratulations card from your bank. Nothing. Just a black hole sitting right in the middle of the most critical planning period of your financial life. I spent 40 years in this industry. I managed money for some of the wealthiest families in this country. I watched people build fortunes from nothing. But I also watched brilliant, careful, hard-working people make one quiet, invisible mistake that nobody around them could see. And the cost of that mistake, I want you to really hear this number, was $430,000, not from bad investments, not from a market crash, not from some exotic financial instrument blowing up in their hands. Timing, pure, simple, heartbreaking timing. And I made a version of this mistake myself early in my career, before I understood what I'm about to tell you. That's what stings the most. I knew the rules. I just didn't know this particular rule existed. So today, my dear ones, I'm giving you what I wish someone had given me when I was sitting where you're sitting. The real story of 61, why the government, and I'll be generous here, I'll say accidentally, built a trap at exactly this age, why this trap gets more expensive every year as the rules shift beneath our feet, and most importantly, what you can do about it right now while the window is still open. This is not some obscure loophole your accountant is hiding in a drawer somewhere. This is a structural feature of the American retirement system, and almost everyone walks through it completely blind. Before I go any further, most online retirement calculators are, to put it kindly, mathematically embarrassing. So, I built a free early retirement calculator for my viewers. It uses BlackRock and Vanguard methodology to show you exactly where your plan has weak spots. I only ask for your email to send the report. No financial data stored, nothing sold to anyone. My link is in the description. Go check your own numbers. I'll be right here. All right. Let me give you a framework, my dear ones, one that completely changed how I see retirement. I taught this to my own children. Think of your financial life as a building, a long hallway with doors on either side. Every door is an option, a tax strategy, a timing window, a benefit tool. When you're young, almost every door stands wide open. Money moves freely between accounts. Tax brackets can be adjusted. Our strategies can be changed and adapted. You have choices, and choices are wealth. But as you age, those doors start closing, slowly at first. then faster. And here's the part that kept me up at night. When I was building my practice, they don't just close, they lock. Permanently. No key, no workaround, no clever attorney reopens them. Once a door shuts, that option is gone forever. Most people, my dear friends, think retirement planning is about one thing: accumulation. Stack enough money, pick the right funds, stay in the market long enough. And they're not wrong. That part matters enormously. But it's only half the picture. The other half is timing. Which doors are still open when you need to walk through them? 61 is the last truly open door. I know that sounds dramatic, but after 40 years in this business, I can tell you, the math backs it up completely. Let me walk you through the timeline so you can see exactly why. Start with 59 and a half. The penalty door opens. You can access your retirement accounts without giving the IRS their 10% cut off the top. Most people celebrate here and stop paying attention. Freedom achieved, money accessible. What else is there? But here's what nobody tells you, and what I told every single client who walked past that threshold into my office. 59 and a half is not the finish line. It's the starting gun for a 3.5-year window that may be the most financially important years of your life. Most people spend it thinking they have all the time in the world. They don't. Now, 62, this is where things get interesting, my dear ones. Social Security eligibility opens up. You can claim early if you want a permanent reduction in your monthly benefits, something I never recommend, but that's a different conversation. What matters more today is something else that happens at 62 that almost nobody talks about. I call it the provisional income zone. The government has a formula, a lovely little formula that determines whether your Social Security benefits get taxed. They take your adjusted gross income, add any tax-exempt interest you earned, then add half of your Social Security benefits. That total is your provisional income. Filing as an individual. If that number falls between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. Cross $34,000 and 85% of your benefits belong to the government. Married filing jointly? Those brackets are $32,000 to $44,000 for the 50% tier, and above $44,000 for the 85% tier. Now you might be thinking, I'm not claiming Social Security yet, so this doesn't apply to me. Here's the thing, my dear friends. The moment you turn 62, you are inside the system. You are now a person who could claim. Your financial decisions start getting measured against these thresholds, whether you asked to be measured or not. It changes your planning horizon. It changes the calculation for every dollar for the rest of your life. Then we arrive at 63, and this, right here, is where I've watched good people lose serious money they spent their whole lives building, money they deserve to keep. At 63, the IRMAA lookback window opens. IRMAA, our income-related monthly adjustment amount. I spent 40 years swimming in acronyms, and this is the one I hate most. Here's how it works. Medicare determines your premium, not based on what you earn today, but on what you earned 2 years ago. Let that sink in. When you enroll in Medicare at 65, they look at your tax return from when you were 63. At 66, they look at age 64. There is always a 2-year lag, a shadow that follows every dollar of income you realize and shows up quietly as a larger bill on your Medicare statement 2 years later. The IRMAA surcharge brackets for 2026 are projected to begin around $95,000 in modified adjusted gross income for individuals and around $190,000 for married couples filing jointly. Step into the first tier and your Medicare Part B premium jumps, roughly $800 extra per year. The second tier adds around $2,000. At the highest tiers, you could be paying over $5,000 extra annually per person. For a married couple, both on Medicare, double every one of those numbers. And at 65, Medicare takes you in. The premiums start. The surcharges hit. The system has fully absorbed you. If you didn't position yourself correctly before 63, you're no longer playing offense. You're playing defense, managing around thresholds instead of optimizing for your own benefit. And that brings us, finally, my dear ones, to 61. At 61, Medicare is not watching you. The look-back window doesn't exist yet. You are completely free. You can make major income moves, Roth conversions, capital gains realizations, strategic withdrawals, without triggering a single IRMAA surcharge, without a single delayed Medicare penalty. 1 year. That's the window. 1 year of total freedom before the retirement machinery turns its full attention to you. And almost nobody takes advantage of it, because almost nobody knows it exists. I need to tell you about a man I'll call Robert, not a client, a colleague. Actually, someone from the finance industry himself. Smart man. Careful. He maxed out his 401k for 30 years and arrived at age 60 with $1.2 million saved, mostly in traditional accounts. Because, as he told me at the time, that's what you're supposed to do. Defer the taxes, let it grow, deal with it later. He retired at 60. He knew Roth conversions were important, but he was tired, and I understood that completely. 40 years of working wears a person down. He figured he had time. He was only 60. At 61, he converted $20,000. Felt responsible. Checked the box. At 62, another $20,000. Still comfortable. At 63, he decided to get serious. He converted $150,000. Totally logical on paper. Reasonable tax rate. Cash available to cover the taxes. Moving money from a heavily taxed bucket to a never taxed again bucket. Smart move. I just badly timed. He called me when he turned 65 and got his Medicare enrollment letter. His Part B premium wasn't the standard rate. It was nearly $500 a month. Because that $150,000 conversion at 63 had pushed his modified AGI directly into IRMAA territory. Medicare looked at that tax return, saw the spike, and treated it as his normal income level. Robert was now paying $4,000 extra per year for Medicare because of a mistake he made 2 years earlier. A mistake he didn't even know was a mistake when he made it. Over a 25-year retirement, that's $100,000. Not lost in the market. Not stolen. Lost to a 2-year timing error that nobody warned him about. And here's what broke my heart when he told me the story. If he had done that exact same $150,000 conversion at 61 instead of 63, same tax bill, same Roth IRA, same goal achieved. Medicare would never have captured it. The look-back window didn't exist yet. He would have saved himself $100,000. 2 years, $100,000. My dear ones, my friends, that is the price of not knowing the doors are closing. You might say, well, shouldn't he have known better? Yes, he should have. And I should have known earlier in my own career. But the financial advice industry is built to help you accumulate money, not to optimize the timing of when and how you access it. Advisors talk about asset allocation, expense ratios, diversification, all important things, but they almost never talk about the sequence of income realization and how it interacts with government benefit thresholds. And the government, they're not deliberately hiding this from you, but they're certainly not putting it on a billboard either. The Social Security Administration sends you nice statements showing your projected benefits. They don't include a guide explaining how your Roth conversion at 63 could drive you into 5-figure Medicare premiums. Medicare sends enrollment packets. No tutorial on IRMAA, look-back windows included. This is structural. The system has thresholds and look-backs and provisional income formulas that interact in ways almost nobody fully understands until they're already inside it. And by then, the doors have closed. Let me give you the numbers clearly. The 2026 IRMAA brackets start at $95,000 for individuals and $190,000 for married couples. The first tier adds roughly $800 per year per person. The second tier adds around $2,000. The highest tiers push you over $5,000 extra annually. For a married couple, both on Medicare, double every number. And what makes this particularly cruel for people with serious savings is this. The very moves you need to make to protect your wealth long term are the exact moves that trigger IRMAA in the short term. Roth conversions count as income. Capital gains count as income. Selling assets to fund your lifestyle counts as income. Every smart move carries a shadow cost if you make it at the wrong age. The only time you can make those moves without the shadow cost in year is before 63. And the cleanest year of all is 61. So let me walk you through the 4 strategies you can execute at 61 that become significantly harder or significantly more expensive once you cross into 63. Strategy 1. Aggressive Roth conversions. My dear ones, you know the basic concept. Move money from a traditional IRA or 401k into a Roth. Pay the taxes now. Never pay taxes on that money again. Beautiful idea, but the timing matters more than the amount. At 61, you can convert as much as your tax bracket allows without worrying about IRMAA. The look-back window hasn't started. You could convert $200,000, pay the income taxes, and when Medicare asks about your income at 65, that tax return is 4 years in the past, completely invisible. You still pay the same income taxes. That part doesn't change. But the hidden surcharge, the IRMAA shadow cost, simply does not exist. You're paying the explicit price without the implicit penalty. Let me give you an example. Married, filing jointly, $2 million in traditional accounts. They know RMDs are coming at 73, and they don't want to be forced into higher brackets. Converting $100,000 in the 22% bracket costs $22,000 in federal taxes. Clean. Expected. Manageable. That same $100,000 conversion done at 63 instead of 61, adds an IRMAA surcharge 2 years later, an extra $800 to $1,000 per year for a married couple, sometimes more. Scale that across multiple years, multiple conversions, and you're looking at thousands of dollars in completely avoidable costs. The earlier you convert, the cleaner the transaction, and the cleanest year of all is 61. Strategy 2. Capital gains harvesting. This one is sneaky, and I mean that in the best possible way. If your taxable income is low enough, the federal government charges you 0% on long-term capital gains. Nothing. Zero. For married couples in 2026, that threshold is projected at roughly $94,000 of taxable income. Here's the game, my dear friends. If you've retired early, your earned income might be low or zero. You have a taxable brokerage account full of stocks that have been appreciating for decades. You can sell those stocks, realize gains up to the threshold, and owe the federal government literally nothing in taxes on those gains, but only while your income is low. Once Social Security starts, once RMDs kick in, once other income sources push you into higher brackets, that 0% rate becomes unreachable. The door closes, and you cannot reopen it. At 61, with Medicare not yet watching, you can harvest gains freely. The income appears on your tax return, but IRMAA isn't tracking it yet. You're getting entirely tax-free capital gains without any delayed Medicare surcharge attached. I once explained this at a dinner party to a younger financial advisor, someone who professionally managed money for clients, and he stared at me blinking for a solid 10 seconds. Then he said, "Wait, you can actually do that." He had clients. He collected fees, and nobody had ever told him that a married couple with no other income could realize $94,000 in gains completely tax-free. Everyone at that dinner table wanted to talk about nothing else for the rest of the night. Asked the dessert, went cold. Nobody cared. That's how buried this information really is. Strategy 3. ACA subsidy optimization. This one applies specifically to those of you planning to retire before 65. People who will need health insurance before Medicare arrives. The Affordable Care Act provides premium subsidies on the health insurance exchanges. A married couple with income below roughly $70,000 can qualify for $10,000 to $15,000 per year in premium support, sometimes more, depending on age and location. Above roughly $120,000, those subsidies disappear entirely. If you retire at 60 or 61, you have 4 or 5 years before Medicare kicks in. That's 4 or 5 years of ACA coverage, and how much you receive in subsidies depends directly on your reported income. At 61, with careful planning, you can structure your withdrawals, your gain harvesting, and your Roth conversions to keep your income within the subsidy qualifying range. Live off savings where possible. Harvest gains carefully. Keep the reported number in the right zone. Over 4 years, this could mean $40,000 to $60,000 in total subsidy value. Real money. Money that goes straight back into your pocket simply because you planned ahead while the window was open. Once you reach 63, this optimization becomes dramatically harder. Now you're managing 2 different threshold systems simultaneously, ACA subsidies on one side The IRMAA lookback on the other. Both punish you for the same dollar of income, just on different timelines. Strategy 4. Multi-bucket income architecture. This is where everything comes together. And this, my dear ones, is the strategy I wish every person in their 50s understood deeply. You have 3 tax buckets in retirement, tax-deferred accounts, traditional IRAs, 401ks, where every dollar you withdraw is taxable, tax-free accounts, Roth IRAs, where every dollar comes out completely clean, and taxable brokerage accounts, where some taxes have already been paid and you only owe more on gains. The ideal retirement is one where you have meaningful money in all 3 buckets, because that gives you the ability to control your income every single year. In a low-income year, you pull from Roth. When you need flexibility, you blend sources to stay just below the key thresholds. IRMAA, like Social Security taxation, capital gains rate cliffs. But building that architecture requires moving money between buckets, and moving money between buckets costs money in taxes. The question is simply, when do you pay that cost? At 61, you pay it cleanly. No IRMAA shadow. No Medicare surcharge arriving 2 years later. You're restructuring your financial house at the lowest possible total cost. At 63, every restructuring move carries a toll. You're still playing the same game, but the board charges you a fee every time you move a piece. Let me show you what this looks like in practice. Imagine a couple, both 61, retiring this year. They have $1.5 million in traditional retirement accounts, $300,000 in Roth accounts, and $400,000 in a taxable brokerage, home paid off. They need $80,000 per year to live comfortably. If they do nothing, they withdraw $80,000 from traditional accounts each year. They pay taxes on every dollar. When RMDs kick in at 73, forced distributions push them into higher brackets. They optimized nothing. They followed the default path the system designed for them. Now, in their very first year of retirement at 61, they do 3 things at once. They withdraw $60,000 from traditional accounts to cover most of their living expenses. They harvest $20,000 in long-term capital gains from the taxable brokerage, bringing total income to $80,000. But the capital gains portion is taxed at 0% because they're under the threshold, and they convert $40,000 from traditional to Roth. Total income for the year is now $120,000. They pay taxes on the traditional withdrawal and the conversion, but those taxes are reasonable, the bracket is manageable, and, most importantly, Medicare is not watching. They've covered their lifestyle, captured tax-free gains, moved $40,000 into permanent tax-free territory, and paid 0 IRMAA surcharges. 3 layers of optimization in a single year. No hidden penalties. Fast forward to age 73. They've been doing variations of this strategy for 12 years. Their traditional account balance is meaningfully lower. Their Roth balance is meaningfully higher. Their required minimum distributions are smaller, more manageable, and far less likely to push them into painful brackets. Their Medicare premiums are lower. Their Social Security benefits are taxed less heavily. They have control over their own money for longer in a system designed to take that control away. Now imagine the same couple did nothing at 61 and 62, then started their Roth conversions at 63. Perfectly reasonable on paper, same amounts, same goals. But every conversion is now inside the IRMAA lookback window. Every dollar creates a delayed Medicare bill arriving 2 years later. Over 12 years, those hidden costs compound into 6 figures of additional expense. Same starting point, same market returns, same lifespan, different timing. When I run the full numbers over a 30-year retirement, the couple who use the 61 window ends up with approximately $350,000 more in after-tax wealth than the couple who didn't. $350,000. That's a house in many parts of this country. That's a decade of additional spending power. That's an inheritance that changes the lives of your children and grandchildren. I'm lost entirely to a timing error. Lost because nobody told them the window was closing. Now let me talk about the long game, my dear ones, because this is where everything connects. Required minimum distributions. Starting at age 73, the IRS requires you to withdraw a percentage of your traditional retirement accounts every single year. You don't choose the amount. You don't choose the timing. It starts at roughly 4% of your balance and rises as you age, climbing to over 10% by your late 80s. If you have $1.5 million in traditional accounts at 73, you're looking at mandatory withdrawals of $60,000 or more per year, whether you need that money or not. That forced income pushes you into higher tax brackets. It increases the taxation of your Social Security. It triggers IRMAA on your Medicare. It is the government finally collecting the taxes you deferred all those decades. You cannot escape RMDs. You cannot negotiate with the IRS. The only way to reduce them is to reduce your traditional account balance before 73 through Roth conversions. But conversions count as income, which means they affect your current tax bracket. Your ACA subsidies if you're under 65, and your IRMAA premiums if you're over 63. You see the problem. You need to convert enough to protect yourself from painful RMDs in your 70s and 80s. But every conversion after 63 carries a hidden surcharge. You're trading one problem for another, and the timing determines whether the trade is worth it. This is why 61 is the sweet spot. It's the last year you can execute significant Roth. Conversions without the IRMAA look-back capturing them. You can reduce your future RMD base while the Medicare machinery is still looking the other way. The math isn't complicated once you see it. A couple with $2 million in traditional accounts who converts $500,000 to Roth between ages 61 and 70 faces dramatically smaller forced distributions in their 70s and 80s. Their tax brackets are more manageable. Their Medicare premiums are lower. Their Social Security is taxed less heavily. They have more control over their own money for longer, but the conversions need to happen early, and the cleanest, cheapest time to do them is 61. Let me be honest with you about something, my dear friends, because you deserve honesty more than you deserve comfortable answers. Most financial advisors are not going to tell you this. Not because they don't care about you. Most of them genuinely do. but their compensation is tied to managing your assets. Yeah, they earn a percentage of your portfolio, typically around 1% per year. Their business rewards them for growing your wealth and keeping you invested. They are not incentivized to optimize the timing of when you access it. Aggressive Roth conversions actually reduce your assets under management in the short term. You're paying taxes with money that could have stayed invested. From a fee perspective, that's the wrong direction. So the incentive to discuss this topic in depth, proactively, while you still have time to act, is structurally absent from most advisory relationships. I once had to ask a certified financial planner, a good man, a decent advisor, why he never brought up IRMAA lookbacks with clients approaching 63. He told me honestly, it comes up maybe once a year. By then it's too late. I'm not paid to do tax planning. I'm paid to manage investments. He wasn't a bad person. He was a professional responding to his own incentive structure. His clients hired him to grow their money, not to warn them about Medicare surcharges 2 years in advance. The system failed them. Not any individual. The system. That is exactly why I'm here making these videos, because someone has to tell you before the door closes, not after. So what do you actually do with all of this? Let me give you 3 specific actions, my dear ones. Real steps, not generic advice. First, calculate your IRMAA exposure before you turn 63. Go to the Medicare website, look up the current income thresholds, model what your income would look like if you did a significant Roth conversion or capital gains harvest. Then ask yourself, what does that income look like on a Medicare premium calculation 2 years later? A simple spreadsheet, and I mean truly simple, can save you tens of thousands of dollars. Second, front-load your biggest optimization, moves to ages 61 and 62. If you're going to do aggressive Roth conversions, do them now. Before 63, if you have appreciated assets in a taxable brokerage account, harvest those gains while your income is low and Medicare isn't watching. The tax code gives you a brief window of freedom. Don't let it close while you're waiting for a better time. There is no better time. Third, model your RRMD trajectory today, not at 72. The IRS provides worksheets for calculating required minimum distributions. Look at your current account balances, project forward. If the math shows your forced distributions in your 70s will push you into painful brackets, and IRMAA surcharges start converting to Roth early. The earlier you convert, the longer that money grows tax-free, and the smaller your future RMDs become. None of this requires exotic investments. None of this requires timing the market or finding some secret loophole. This is pure structural optimization, understanding the rules of the game and using them to your advantage while the window is still open. If you found value in this, please subscribe. I've been told that without engagement, YouTube buries these videos, and I have much more to share with you. My entire purpose here is to give young people access to the kind of thinking that used to require a wealthy family or a 6-figure advisory relationship. That was never right. It never should have been. Before I finish, I want to say one more thing, something I believe matters just as much as the math. Throughout your entire financial life, my dear ones, you accumulated. You saved, you built, you watched the numbers grow. That felt good, and it should have. You were doing exactly the right thing. But in retirement, the equation flips in a way that catches almost everyone off guard. Income is no longer purely good. Every dollar you realize could push you into a higher cost bracket for healthcare premiums, increase the taxation of your social security, or trigger cascading effects you didn't anticipate. The rules of the game change, and most people never get the memo. I've watched people with $2 million in retirement accounts lie awake at night, unable to sleep from the fear of running out of money. That fear is understandable. I've felt it myself. But in my experience, the more likely problem for serious savers isn't running out of money. It's running out of tax bracket space. The tax code has thresholds everywhere. Cross them by $1 and you pay more. Stay under them and you keep more. The difference compounds over decades into numbers that would genuinely surprise you. And the system has already designed a retirement for you. If you do nothing special, if you follow the default path, that retirement includes more taxes than necessary, higher Medicare premiums than necessary, larger RMDs than necessary, thresholds you cross by accident, and surcharges you never saw coming. It is a perfectly functional retirement in the same way that a maze is a perfectly functional route from one end to the other. You'll get there. You'll just leave an enormous amount of money behind along the way. Or, and this is exactly why I make these videos, you can design your own retirement. You can learn the layout of the maze. You can see the doors before they close. You can walk through 61 with intention, with strategy, and with the full advantage of knowing what you now know, while everyone else is still wandering toward 63. The system doesn't punish ignorance out of malice. It simply doesn't reward it. But you are no longer ignorant, and that changes everything. I love you all very much, my dear ones. Now go do something with this information while the window is still open.